Hello everyone, welcome to the LPEA podcast series, Carried Interest Unpacked, where we explore various aspects related to carried interest. My name is Lutfije Aktan, I'm an audit partner at KPMG, and today I'm joined by Laurianne from Marguerite and Vincent from BDO to discuss carried interest from the angle of financial reporting. First question goes to Laurianne. From your experience, is there a difference between expectations from investors compared to the GPs with regards to financial reporting?
Well, both LPs and GPs are looking for transparency, but from a different angle. For LPs, it's all about predictability of returns. They want to know how the carry works, how it kicks in, and when it might start impacting their returns. For GPs, it's all about remuneration and performance. The focus is the visibility, how the visibility of the performance will be translated into carried interest. And one of the things that we've seen is a growing trend, that LPs now are requesting disclosure of the NAV after net of carried interest, so after carried interest. Now they request such information in the capital statement reporting, and that's something that we haven't seen much the last few years. Now a question for you as auditors, Vincent, Lutfije. In the financial statements, I mean, you've seen as auditors a great deal of GPs. What are the main gaps in Luxembourg and what are the main differences?
Well, I would say that Luxembourg provides some flexibility in terms of the accounting framework that can be used from Lux GAAP, IFRS, which are the most common, but also US GAAP, in certain cases LPA GAAP. Depending on the GAAP and also the provision of the LPA, the carried interest might be an NAV allocation or an expense, and there can sometimes be some judgment in the determination of the one. What matters in the end, from a regulator expectation and also from investor, like you mentioned, is that the NAV attributable to LP is net of carried interest, whether it's because it's an allocation or an expense. That's really the critical point. And I believe, Lutfije, you had some particular case that you wanted to share when it comes to LPA GAAP.
Yes, we have some clients who prepare some sets of financial statements prepared under LPA GAAP, which is non-GAAP basically, but they have these on the top of their official financial statements. And this is for financial reporting perspective for the limited partners in accordance with the LPA basically. So from my experience, I've seen cases where carried interest was only disclosed on a realized basis, and these accounts were not actually fit for purpose because the NAV attributable to the limited partners was gross of carry. So if we think about the perspective of fund of funds, for example, or feeder funds, that information would not be relevant to them for the preparation of their own financial statements. So as a minimum, I would still recommend to disclose the amount, to disclose the mechanics in the financial statements, even under the LPA GAAP, regardless of whether it's recognized on an unrealized basis or realized basis, because it's, from a transparency perspective, it's very important, and investors are missing a very important piece of information in there. Now, Laurianne, what's your view on carried interest from the perspective of the carried interest partner?
A good question. It's slightly different from GP or carried interest partner angle. For GP, the key difference is timing, meaning that GP or CIP will recognize the carried interest only if it's virtually certain. As we discussed, at the fund level, you may just recognize the unrealized carried interest once the hurdle is reached much earlier. So some economics, different timing. One question I have for you, maybe Vincent, that I came across investors seeking confirmation that the carried interest figures in the financial statements are audited. What do you think?
Well, as we've established, the carried interest figure must be disclosed in the financial statement, and as such, it is covered as part of the audits. That being said, the audit opinion is financial statement as a whole, it's not specifically on the carried interest. So when investors are looking for specific comfort, what we've done in practice is prepare a dedicated report, for example, an agreed upon procedure report, targeted specifically to the procedures performed on carried interest, and such report can then be shared with the limited partners. And finally, Lutfije, since this podcast was originally linked with the introduction of the new carried interest regime, can you maybe, to conclude, tell us what's the impact for financial reporting?
That's an easy question, actually, so thanks for asking. From a financial reporting perspective, there is no impact based on the analysis that we have performed. I would like to invite our audience to view our episode discussing carried interest from a tax and legal point of view. So this closes today's podcast. Thank you very much, Laurianne, Vincent, for joining me today in this episode.
Thank you.
Thank you.
Thank you.